Live as well. I think there's always like that delay.
Yeah.
There's always like that delay. Yeah, there it is.
There it is. All right.
Okay, so we are live. It's always a surprise for when we're live. Okay, so okay, all right. So I think everybody is here. Okay, yeah. So a bunch of people that were already waiting. Thank you everybody for patiently waiting. I know these live streams sometimes take a little bit of inertia to get over on the live stream because of the delay and all that stuff. But thank you. So welcome everyone to episode 8 of the iFlip AI Circle. This would be the first time that we're doing it on the second Wednesday of the month. As a reminder, if you didn't already know, we are going to be doing these on the second and fourth Wednesday of the month, starting from December and onward. So you'll be getting double the amount of Kelly Korshak that you would normally.
Oh, joy.
And excuse me?
Oh, joy.
Yeah, yes, that's the people have spoken. That's what they wanted, Kelly. They wanted more of you. So this is the start of that. So mark your calendars every Tuesday and every second and fourth Wednesday of the month. Starting here on out, you will be tuning in to the AI Circle. Today was a crazy day. We had another Fed announcement. But before we can get into any of that, I know we have to go through everyone's favorite part, the disclosures. So please bear with me in reading this wonderful piece of poetry here. The disclaimer is iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make any buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak to your CPA or financial representative to ensure that the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, I'm going to pass it on over to Kelly. And please explain to us what happened today, Kelly. It was kind of a crazy day.
I'm going to kind of caveat that. I don't think it was really that crazy. I think we can put everything, okay. I'm going to continue to try to put everything in context with the people that watch our webinars, videos here. In context, I think right now it's pretty clear that the market wants to go up. Mm-hmm. There is an underlying bid to the market because there is a prevailing idea, especially with the new kinds of money managers out there, which are literally maybe 10 or 15 years, not quite as old as I am, that have never really seen, except early on in their career, the 2008 financial crisis, but of course, very few of them have seen the 1980s inflation issues that occurred literally from 1978 all the way through 1982 and even beyond that. Back in the original, the last time there was this kind of an inflation, it was caused by wage price inflation. Wage price inflation is essentially when jobs became very hard to pay people. At that time, it was due to unions. And in the 80s, the unions kind of lost all of their power as a result of a sentiment at that time that prevented unions from increasing their wages easily by holding hostage one entity in a sector, like hold GM hostage, and therefore Ford and Chrysler will follow suit on whatever deal GM makes with the union. We are seeing something very similar to that now. Right now, Early on, it was price inflation as a result of the money put into the system. And at that time, people coming back to work, a combination of both. Now, even though we've seen energy prices fall, we are now starting to see a labor market that has been squeezed. It's very tight. They're putting on a lot of jobs, as Jerome Powell said today, about 272,000 jobs, literally per month, which is a good number. We're still at low employment, even though we have a much higher, a lower participatory rate. So all that is a bunch of kind of economic talk that boils down to this. Interest rates are going to continue to go up, albeit they won't go at about 75 basis points per meeting. They will now maybe go up at 50 basis points per meeting. Today, the market became disappointed when the came out with a 50 basis point rise. Some of the market participants were actually believing that there would only be a 25 basis point rise, or maybe even none, thinking that the Federal Reserve has inflation under control. We saw 50 basis points, not 25 or 0. And also Jerome Powell came out afterwards, and when he talked afterwards, it even became worse. And what he said afterwards is they are going to remain diligent in the course of inflation, which means they will hike rates further in February, which will be their next meeting. So look for another 50 basis points in February. That's going to put us at 5.25 on the short term 2-year notes and the Fed funds rate. And also look for longer interest rates to start to kind of creep back up again to maintain around as much as a 2% or lower spread. Right now it's at 2% spread, and I expect it to go to 1%, which means I expect interest rates that have come down 1 full percentage point on the 10-year note to literally go back up another 50 basis points by February. So the market became at where I'll reiterate, the market was disappointed that the Fed raised rates at all. And then they didn't like his language afterwards, and they took away a 300-point rally on the Dow and turned it negative by the end of the day. And by the way, yesterday was another example of the market trying to understand where it wants to go up. But the reality is there's a lot of supply at a higher price. So this being said, the reason we're doing 2 times a month now on this AI circle is because in general, I think the markets deserve that. I think our customers deserve to hear really a little piece of at least what I think is my experience in seeing these kind of things before, and what our expectations are of both. So we have a general idea of where the expectations of the market is going to go. And by the way, what our algo, machine learning, AI will do in these kind of events and this kind of world that we now live in. So I still expect on a go-forward basis that the market will maintain a bid the best it can through Christmas, maybe even New Year's, maybe making the market go up another 100 S&P points, but it could be down another 100 S&P points very easily within the next remaining 2 weeks of the year. Finally, I expect in the beginning of next year, the markets to resume a downward trend. We are at the high point of our move on the S&P. Maybe, Aaron, could we share a screen?
Oh, yeah, you got it.
Do it again. Let me hit share. There
You should be able to do that now.
I can.
Okay.
And I'm going to put this over here, everybody, and make it large. Move this away. All right. Here is the S&P 500 spider. Kind of interesting, and I pointed this out. Look at the end of the year of 2023. 2021, December, right here is the end of the year. There's the 31st of December, literally a high for the year at the end of 2021. Let's look at it at the end of March. The first quarter, from this first quarter, we made a low in March that literally took it from an upper standard deviation to a lower, literally about an 8% move, and then a rally at the end of March to kind of close out March. Not so bad. That was March means the first quarter. The second quarter, however, ended up absolutely terrible. We had a complete fallout of around literally about 11% at that time, putting the S&P down 24% of the year, followed by a little modest tiny rally to end the second quarter, literally very close to its lows. The third quarter had a very surprising rally in July. Look at that. It made a high all the way back up to 4,300 in the S&P, where people were at that time were thinking in the middle of August that maybe this isn't a bear market. Here is when people were saying the move is done, the lows are in, only to see what happened literally by the end of the third quarter, where it set a low. Literally, the last day of September, it made a low for the year. Notice how the market is putting in highs at the end of the quarters and lows generally towards the lows inside the quarters, and then lows literally on the dot, as we saw here for the third quarter, where it put in a low. The fourth quarter has been a good rally, but not like the rally that we saw in the third quarter, only to fail by the end of the third quarter. Here's what we have now. We've had literally an 8.5% rally in the S&P, putting the S&P year to date still down a lofty 17% on the year. And here sure looks like resistance. This here is close to a 200-day moving average. This sure looks like resistance to me. I would be a seller here in my old capacity, and I would be risking maybe these highs. I expect the market in the beginning of the first quarter of next year to resume and literally make new lows. At the time of the first quarter, however, I do see a possible entry point for the S&P 500, and that bodes well for a lot of other stocks. Literally, by the end of the first quarter, should we reach levels around 35 to 3,400. I do not anticipate a rally above these levels, but look for our possibility that the AI, however, is turning more friendly, and we are starting to get minor signals to be able to push us into the market. And at the end of the day, whatever my opinion is, folks, we will follow the math. But so other people understand, and this is kind of important as well before we get into question taking. This is the S&P 500. This represents the benchmark that we all care about. This is the real world. What is not, but look at the NASDAQ here. Let's take a close look at that. The NASDAQ, everybody, is down quite a bit worse. The NASDAQ is literally down 5,000 points as of now, and it's off its lows. That it represents a 32% loss on the year. And the NASDAQ, of course, contains the stocks like Apple and Amazon, and we know them, Google, Meta, all of those kind of Netflix. We know these stocks. These stocks have been devastated. Most everything I follow has been devastated outside of the oil stocks. So these things don't show any kind of recovery, really. They're off their lows, but look in the first quarter for these stocks to possibly make some new lows, however, probably overperform the S&P. What has done well, and what unfortunately the world watches, is the Dow Jones. The Dow Jones, of course, is the most meaningless index there is. The Dow Jones is only literally down about 10% on the year, maybe 9%. But that doesn't represent reality. We are talking about 30 stocks. And when you see the pundits and the talking heads on television talking about the rally, they'll have a little sign saying market in rally mode and market rally, and yet the NASDAQ will be down on the day. The S&P may be flat on the day, but they'll signal market rally. Why? Because they only watch this index. And this index is poorly created, not representative of the country and truly what's going on. Before I leave and get into question mode, let's quickly look at the dollar. I think that's very important. The dollar continues to make new lows. It has definitely come off its highs recently, and we can see the dollar index at one time was as high as around 114. It's all the way down to 103. We know that's approximately an 11% loss. The euro has went from literally below par to 106. However, it's down massively through the year, but it's undergoing a rally. Why? Because traders in the US are expecting lower interest rates. Lower interest rates mean other currencies can compete more with the dollar, meaning that their stocks might look better, so they don't want to buy any more dollars to buy our stocks or bonds. Then they will go for their own currency bonds or their own currency stocks. And let's look at the yen, because I've talked about it.
Mm-hmm.
Yen has also finally come off of its highs, but again, when interest rates start to go up again next year, early in the year, look for this to resume a rally where the dollar will continue to rise up. However, we may have seen the highs here. And this play, I have done some work on, and we may offer an ETF product that will manage this situation. I want everybody to look for that as one of the things for early in the first quarter of next year. Mm-hmm. Finally, we should look at Bitcoin. Given all the stuff that has gone on recently, especially with FTX, Bitcoin is kind of hanging in there, folks. I think the worst is over for this, even though the contagion still exists. I do not recommend buying this. However, if you own it, I wouldn't sell it, and look to possibly be more interesting if we can start to see a rally of Bitcoin above 22,000 or so, in which case I could tell you our products will signal a buy. We've been out of this forever in terms of our algorithmic AI approach. The algorithmic AI approach is excellent on this particular kind of product, and we all used Global Bitcoin Trust. I think that's going to hang in there. It's doing the same, it's behaving pretty much the same way Bitcoin is, which is all we really care about. And so it still remains a good proxy. Finally, real quick, I'm sorry it's going over, Aaron, by 3 minutes. Let's look at the 10-year note. 10-year note, look at this. Today, we had, the market was pretty much flat on the day. I feel this is a long-term deep bear market, which I remember this could last literally cycles that could last for years to come. If this is true, that does not bode well for the stock market. We want to maintain higher cash positions, and we will look for more dividend plays that will come out in, for example, the Conservative Plus and a dividend product as well. We are working on all kinds of new strategic portfolios to represent opportunity we feel that can be managed again through computers and mathematics. So on that note, by the way, anybody that looks at this chart, if you can see it, that sure doesn't look like something I really want to buy. If you consider, if we can go back far enough, that this market came, this is as far back as we can go, but I can tell you, this market came from the price of 60. As far back as I go here is 107. It was literally almost half this price over here on the left side of the screen. And we are now looking back literally to 2006 before the financial crisis. We are in a new world with interest rates. And as a result of that, we cannot just get overly zealous in the stock market, despite the zeal that we all see periodically on the TV shows. And remember, those TV shows are designed to make people feel comfortable with owning stocks.
Right.
And so that is a misnomer. These are not traders. These are just talking heads that are promoting their own book. And I would, of course, like them to be correct. The market is easier to make money on when the market is going up. Very difficult when it's going down. But nonetheless, it's very reasonable to see interest rates rise. And the stock market, of course, will be the last one to understand what the problems are. It is forever optimistic. That's why it goes up. The bond market, however, I think remains the smarter money. And what happens in the bond market is what I really want to follow, because ultimately stocks must behave in accordance to interest rate parity. This is the one thing I learned in my career, and no mathematics will stop that. And for that, Aaron, should there be any questions?
Yeah. Well, we have to get through them kind of quickly, but one thing that I want to ask you, when you mentioned that the Fed, that there was a looming presumption that the Fed had inflation under control. Why might they assume that going into the Fed announcement? Can you clarify that a little bit?
It's because they can see what the bond market has done here, and I strategically did that one last. The bond market has started to rally as well in price, which means that yields go down. This is the 10-year note. The reduction of this gives especially stock participants a time to feel they have now hit a bottom, because the interest rate market seems to have bottomed. But if we look here, back again in the middle of June, the end of June, it was the end of the third quarter, it did the same thing. It had a rally of greater magnitude than the one we have now, only to subsequently fail and make new lows. Again, over the beginning, since the end of COVID, this is where COVID is, right? March of 20, interest rates literally hit their lows. Mm-hmm. March of 20's COVID, we now know. Ever since then, they've made no new highs. It just keeps trying. And what this is, interest rates are a function of all the money that's in the economy. And now they are realizing that money is being taken out. If it's taken out, that means they're raising rates and they're reducing their balance sheet by no longer doing bond repurchases. Interest rates have gone up in yield and down in price. I look at this as no more, is just a bull rally in a bear market.
Wow. That actually kind of segues, I think, into one of our questions for tonight, is how does this market condition, like the status of the stock market and the bond market and all of it in its totality, how does that relate to the real estate market? We got one of those questions in for today.
Deeply, in one sense, we have two things. We have a lot of dynamics going on. I can't just say there's two. We all know that demand for real estate, especially single-family homes, is a function of the mortgage rate. The higher the mortgage rate, the lower the demand. Mm-hmm. Now, if there's lower demand, that means whatever supply exists, which, by the way, is on the minimal side, has to go for cheaper. If there's no demand, the supply, that means someone that wants to sell has to be able to meet whatever the demand is at the time. Well, if there's very little demand because of mortgage rates, the only people that can buy are those with a lot of cash, and they take out smaller mortgages even though the mortgage rate will be higher. It has a profound impact on price of real estate. So real estate right now actually has gone down in a lot of areas, but it's remained steady in so many others. For example, city prices are still very high. LA, New York, certain parts of Arizona, large city prices have remained pretty much intact. However, peripheral properties have definitely gone down. Mm-hmm. Also, commercial real estate has still done well. Why? Because commercial real estate actually is able to borrow at much more advantageous rates because they are further out on the curve. They're able to take out rates that are not tied to something called the prime rate, which is closely related to the Fed funds rate. Our mortgages, when you and I and all the people listening go to the market to get a loan, we're going to have to pay something around Fed funds plus. That's why these mortgages are now 6.5% to 7.25%. If the long-term interest rates, in other words, if this market here starts to continue to rally, you can bet housing prices and real estate will go up in value again. However, if this basically fails anywhere soon, you can count on the real estate market to still have its issues going into the first quarter.
Got it. Well, I hope that answers your question. I don't have who submitted that real estate question in front of me, but it was very interesting. Hope that answers that question. Our next one is, what stocks are positioned for success at the beginning of 2023? I know you have a bearish outlook, but are there certain stocks that you're maybe bullish on?
There are a lot of stocks that have done very well in this market and probably have a better chance of recovering in the first and second quarters of next year. I actually mentioned and alluded to it a little earlier. I think some tech stocks, like the Amazons and maybe Netflixes of the world, might have been getting closer to bottoms, where they become more attractive, where you realize you no longer have a 50% risk in the ownership of the stock. You might have a 15% risk. So if I were to nibble at things, I would be looking at, here's an Amazon, for example. Notice that Amazon here is at the COVID prices. Here's COVID and what it did to Amazon. And then Amazon realized the money was pumped in. We all bought everything online from Amazon. It went up, and now it's back down to COVID pricing. So this starts to look attractive at a COVID level in this price area. Also, if we were to buy it, what would we be risking? We might risk from 90, we could risk literally $20 a share down to 70, and in which case $20 a share is 20%, call it. That is a reasonable bet on a stock that shows great history and growth, that literally from 90 has the potential to literally double to 180 where it was before. And when you have big stocks, high quality, been around a long time, that have a chance of doubling, you kind of want to buy them. I am not sanguine on the, even though they've hung in there, I'm not sanguine on the well-known stocks like ExxonMobil. I think they're going to hold in for a while because of oil prices and what's going to happen, I think, somewhere in the first quarter. But if there is demand destruction, this won't look good. What still will remain okay, though, is these pipelines. Why? Because, again, the downside here is maybe down to $10.60 or so, call it $10 a share, which is about an 11% drop. But if that does it, it's paying 8% a year. At 8% a year, if you're getting a dividend like that, why wouldn't I own it? Because if I can risk 20% and still get 8%, that means over 2 years, I get the stock even and I'm getting the dividends. And what happens if the stocks go up? I love these stocks still. I like stocks like also that I think has opportunity next year would be some of the stocks that have hung in there well. Let's look at Google. Google, for example, has gone down. Here's the COVID lows again. These COVID lows. Here we go. Here's the COVID low. It's maintained it, but it got kind of close to COVID pricing. If we can see anytime Google get into the 70s or so, I sure think the AI could see that. And we would want to probably be owners of Google in this area if we can get there. And I think that's a possibility in the first quarter. I also think there's some stocks that are going to be do very well inside of COVID time or a bad interest rate time. And here's one of them. It is AMT. AMT is a stock that I love, but it's been persecuted recently. but it's going to hang in there. Remember, AMT is offering also about a 6.5% dividend. And when you have higher interest rates out there and you want to have some upside opportunity, dividend stocks look very good to me. And there's a plethora of stocks that have done well that maybe could also do well or manage themselves well in the first quarter. But I really think that the time for all of us to start looking for things that do well will be somewhere at the end of February, early March, before the first quarter is done. We really need to see, people, how the world plays out in the first quarter. Already the tech companies have announced job cuts. It is just that the rest of the country has not, because it's been in a tight market, but there are layoffs coming. I hope it's not anybody listening to this, but when those layoffs come and there's demand destruction, all ships go down. The ones that have rallied the most will go down the most. The ones that have already been punished, like most of these tech stocks, will probably go down the least. And so I feel honestly that the next 3 months, starting now, right now, that take us into the March are going to be very, very dangerous.
Gotcha. And I know we're a little bit over time, but if you could squeeze this one in very quickly, I think this question is really, really good. What do you recommend as a due diligence checklist for retail investors? If you can kind of bullet point that out.
You mean for retail investors that want to buy a stock, or they want to get
The question didn't specify whether it was stock or real estate or anything like that. I think it was just looking for something in general.
It always, I think I mentioned this before in maybe some different question, but for retail investors, anything they buy, the main due diligence, whether it is a stock or a private equity investment or a real estate investment, it comes down to, again, to the 3 Ps: people, product, performance. When you invest in a stock, it's really, what is the stock? Its product. What is its performance, which we can measure historically? And what are the people? In other words, are management now, are they current? Have they been there during times when it prospered, et cetera? So if you have a brand new manager to a new company, like when Tim Cook took over Apple, you have to be from Steve Jobs, because he passed away. You have to be wondering, can Steve Cook do as well as Tim Cook do as well as Steve Jobs? The first bet would be no, but Tim Cook has proven that he's able to move Apple along. So the people side has been handled by that in terms of investment in a stock. But the same thing comes true when you're buying real estate from someone and or a private equity investment from someone, is to make sure that the people are genuine. Being genuine is something that a lot of times is a feel, but the main question to figure that out is, what is their experience? How long have they been doing it? Have they had any kind of personal performance, personal track record? What did they do before? People is the hardest thing to measure, but probably the most important thing, especially in investment somewhat outside the stock market. It's very important that the people are people you can look in the eye and trust.
Yeah.
Product, of course, is really what you're buying. Is it real estate? Is it a company? Is it a stock? You should know exactly what it is. Real estate's the easiest because it's tangible. You can see it. You can do comps on it. You can go on the internet and find out exactly, what other houses or commercial property around it, how it's done, how they've done, and what those current prices are. So you can measure what you're buying against other things and find out if that's a value. So if someone's trying to sell you land at 100 grand, but it's being sold for 30 grand, next door, you probably don't have a good person selling it to you.
Right.
So that's really a critical thing. And then
Yeah.
finally, what is the performance? I go down to the third P. Performance in a stock is the easiest thing in the world to measure because we have charts. Charts kind of say it all. But the performance in real estate is, look, real estate has always been a good long-term investment, but it's very long-term, even much longer term than a stock.
Right.
And real estate is something that if I'm buying it, and I do buy real estate, I like, or invest in it rather, I like to invest in things in real estate where I know it is very saleable, very liquid. So the product you invest in should have some level of liquidity if you can. In real estate is why most people go there, is because it is liquid. If you have to sell it, somebody will buy it. And that in real estate, even though it's problematic right now, there are opportunities in real estate to be sure, but you just got to make sure you do a good job on those 3 Ps.
Yeah.
And don't be afraid to ask tough questions.
Absolutely.
That's very, very important. Ask the questions that almost seem rude. Because if you can get a good answer out of that,
yeah,
you probably want to continue the conversation. You
Yeah.
don't want to have anybody just say it's a good deal. Trust me. Those are the words that are very hard for me to come out of the mouth because I don't trust very many people.
Yeah.
And it's, I want to verify it. I want to trust them, but I want to verify that I should trust them.
You know, I can totally relate to what you're saying, Kelly, and I'll just wrap this up here. As you know, before I joined iFlip, I was at a hedge fund here in New York City, and we're not shy about sounding rude to anybody, to anyone, anytime, anywhere, right? And so I've overheard a lot of these types of questions, and sometimes in some colorful language, at work. But and I can relate to it on another level, because one of the things that we were a very strong traditional, fundamental, old school kind of a hedge fund. And at the time, I didn't really understand this, but we spent a lot of time. And I talked about this in our crypto class. If anybody here, give me a shout out if anybody attended the crypto class all the way back in January. But I mentioned this in the crypto class back then. We spent a lot of time. Our research team, anyway, spent a lot of time analyzing like personality profiles and everything like that from the leadership team of new companies. And I didn't get it at the time. Like, why does that matter? Like, I thought stocks were all about the charts, right? I thought it was just about the performance. But we spent a lot of time and a lot of resources on the people side of things as well. And now that you're saying it, it just kind of reminded me of that. All right, so that's it for our show today, everyone. I know that we had some more questions than the ones we went over. We will get to them eventually. We'll consolidate some of them. Some of them were very closely related to each other in our upcoming shows. Don't hesitate. Leave a comment below if you want to submit a question, or email it to mailbag@iflipinvest.com. Again, that's mailbag@iflipinvest.com. Or just comment after this video becomes published. The last thing I'm going to leave you with is the winner of today's raffle prize is John Ryan. I don't know if John Ryan, if you're here, please raise your hand, give a shout out, comment in the chat room so that to let us know that you're here. You are our winner for tonight. Just let us know that you have you've met all the requirements. And for anyone who doesn't know, the requirements are: you must be subscribed to the iFlip YouTube channel. You must be a iFlip customer. So you must have an iFlip investment account that's funded and working, and preferably in a smartfolio, but we're not going to make that a requirement just yet. So send us a screenshot that you have of your iFlip account. And the third requirement is that you got to be here. So I don't know if John Ryan, if you're here or not, right? I may let that one slide just because it's the first one. But watch the replay. Reach out to us. You need to send us the screenshot anyway. And your prize is the recording of the Master of the Markets live events that we did back in Dallas. and we'll be doing more of those later. So we might give away tickets and all that stuff later. So stay tuned. This isn't going to stop. We're going to continue to do these giveaways at every live stream. So you want to tune in, mark your calendars. I haven't heard anything from the chat. I can't see anything. So I'm going to assume John Ryan isn't here, but hopefully we'll catch you on the replay. For now, I'm going to say, good night to everybody. Make sure you like and subscribe. Hit that notification bell. Don't miss an episode because you don't want to miss out on being a potential winner for any of our giveaway prizes.
And one last thing we have to say, Aaron, we got to make sure we say happy holidays. That's
right. Well, they'll see us. We have our mailbag episode next week. And we have another, we'll be coming at you from Vegas, by the way, Lee and I, because we'll both be in Vegas. We won't be in the Zoom situation. It'll be live for once. And then we'll have another show after that with you, Kelly. That's because that's the 4th Wednesday of the month. So yes, if we don't see you, happy holidays. But we have a couple of more shows coming before the end of the year. So stay tuned.
Good night, everyone. Good night.